Hi there, this is Jared Woodard of Condor Options. Everybody pays attention to the VIX and as a general barometer of market risk, but I want to take you today through a little tour of some other volatility indexes to see what things have been like in other tradable assets. We'll start first with equity indexes, and the chart on your screen shows you the past year of implied and historical volatility for the Russell 2000 on the top panel and the NASDAQ 100 on the bottom panel. For all the charts we're going to look at, the yellow line indicates the implied volatility at a 30-day horizon on any given date. The blue dotted line shows you the historical volatility for that asset, the actual rate of changes of price for the underlying asset or index. You can see right now that in the case of both the Russell and the NASDAQ, we've got a pretty big gap that's opened up between the implied and the historical volatilities, which is really just a function of how quiet stock markets have been in recent trading. So even though the actual historical volatility is quite low, we're talking about below 10% at a 1-month horizon for the NASDAQ and just below 13% in the Russell 2000. Option markets aren't really buying that as a likely future outcome. So options are pricing in much higher volatility over the month ahead. In the case of the NASDAQ, we're talking about something closer to 16% and maybe 21, 22% average implied vol for the Russell. So in other words, markets are already pricing in a reversion to the mean in terms of volatility, which for directional traders would just mean some selling pressure or a mild correction or anything that could cause volatility to increase. If we look now at energy, I've got charts on your screen now for crude oil and natural gas. The crude oil picture has been the same recently as it's been for the past few months. There's uncertainty about supply issues in the Middle East and possibly Nigeria. And while that's kept a bid in implied volatility in oil, the actual volatility of the futures contract has not been as high. That means it's been a winning bet for the last several months to be a net seller of options rather than a buyer in pure volatility terms. And the same really holds true for natural gas as well. Even if we exclude this huge spike in volatility in the last several sessions, really, since last fall, there's been a persistent bid in the options that's been higher than the actual price volatility realized in the underlying contract. With the big spike in natural gas volatility more recently, I think the options are more fairly priced, and so I don't see any edge here in terms of being a buyer or a seller. Turning now to FX, I've got charts for the euro and the Australian dollar on your screen. And what's interesting, I think, right now is in the euro, the really persistent risk premium that we've seen in the options markets for quite a long time has really started to come away, to get sucked out, as it looks like financing operations are starting to work. And so even though the actual contract has become more volatile as the euro bounces back, the high premium in options markets has declined. So the options are priced now around 12%, which is just 1 percentage point above where the euro futures are trading. That means I think the best days of selling options for the euro look to be over for now, and it might even be time to look at some long volatility exposure. For the Australian dollar, I don't really see any edge here. I think this is just noise on the volatility front, and so I'd probably look elsewhere. Last, I want to look at metals. So we have 3 charts now on the screen for gold, silver, and copper, respectively. The story in gold and silver has been one in which it's been hard to be an option seller the last few months. I think that the picture will probably be the same going forward. You get these sudden spikes in price movement for both gold and silver that can really kind of overtake anyone who's a net short or net seller of options. I think if anything, it's a better environment to be an option buyer at this point, and that's the attitude that I'll take going forward. For copper, our data here looks like we're missing some option data, or it's spotty at various points, but the basic level is right. And if you want to take a more aggressive volatility position in metals, I think that copper is probably a better way to go if you can find the liquidity and get good execution. So we just managed to survey the volatility universe without once mentioning the VIX, and If you have any questions, feel free to get in touch on the site. Thanks.